Thank you all for joining today's 45-minute webinar sponsored by Dynamo Software and in partnership with the Spaulding Group. As an attendee, you will have an immediate access to the collateral we have posted in the handouts area. And if you have any issues downloading, you can send an email to events@dynamosoftware.com. As you listen to today's presentation, please feel free to submit your questions using the Q&A capability of GoToWebinar. Now, let's get started. My name is Donna Parent, and I'm the Chief Marketing Officer at Dynamo, a market-leading provider of end-to-end cloud software solutions for the alternative investment management industry. We have partnered today with the Spaulding Group, the institutionally recognized boutique performance measurement consulting and GIPS standard specialist firm serving the investment industry. Our session today is focused on alternative assets, addressing performance measurement and analysis challenges. Today we have a panel of roundtable speakers ready to answer your most burning questions around this topic. First, before we get into all of the panelists, I would like to also welcome Mike Slemmer to today's session. Mike is the LP Sales Director at Dynamo, covering parts of the US, Canada, and South America. Mike has over 30 years of sales and general management experience in investment and performance measurement and risk technology at Thomson Financial, now Thomson Reuters, SS&C, and FundCount. Over the past 3 years, he served as a judge for the Family Wealth Report Awards and Wealth Tech Americas Awards and has spoken at many investment technology forums. Mike is a CFA charter holder. You see Mike here on the video along with our additional roundtable speakers. Now let me introduce who else we have on board today. First, John Simpson, representing the Spaulding Group. John is the EVP and Chief Ethics Officer at TSG. He has been with the firm since 2005, where he regularly conducts GIPS and non-GIPS verifications, as well as GIPS examinations. He also teaches classes on performance measurement, attribution, risk, and GIPS, and conducts software searches, operations, and technology-related consulting assignments. John is a regular speaker at industry conferences and society programs. He is the co-author of TSG's Guide to the Performance Presentation Standards, put out by TSG Publishing 2012, and has written numerous articles. Prior to joining TSG, John has spent 20 years with Integrated Decision Systems, a New York-based software vendor that provided portfolio accounting and performance measurement solutions to the investment industry. Welcome, John. John is also joined today by Brad Sinclair. Brad is the managing director of the performance function at CPP Investments, a large Canadian pension fund where he is responsible for calculating returns of all the fund's investments and their benchmarks along multiple dimensions to assess investment performance. Prior to joining CPP Investments in 2016, Brad worked at Midsize Asset Owner from 2013 to 2016 and at an asset servicing firm from 2006 to 2013. He holds a Master of Finance from the University of Toronto, is a CFA charter holder, a Chartered Alternative Investment Analyst, and has obtained the Certificate in Investment Performance Measurement. Welcome to you too, Brad. And finally, we also have Frank Vitellio joining us. Frank serves as Investment Operations Director at Boston University. Frank has over 30 years of industry experience working at a couple of the custodians and administrators in Boston. He has also worked at Cambridge Associates and assisted in the formation of their investment operations team for outsourced client offerings. He earned his master's in finance from Boston College. Welcome to you too, Frank. And as a quick side note, opinions expressed in today's webinar are those of the speakers and panelists themselves and do not necessarily reflect the views of the organizations they currently work for, its management, or employees. Again, welcome to John, Brad, and Frank. Now let's get things kicked off. Mike, I'll hand things over to you now.
Thank you, Donna. And as we go through today's webinar and questions and topics, we will be referring to two research reports, one from Dynamo, the second of our LP research reports released just recently. You can see that in the panel on the left. And also the Spaulding Group, which has replicated its earlier 2014 performance measurement asset owners study. And you're going to hear statistics from those reports, and we'll be using those in our questioning today. So let's get started. Performance measurement on alternatives can be challenging because these investments are often characterized by asymmetric risk-return profiles, limited portfolio transparency, illiquidity, product complexity, and complex fee structures. So, panel, I'm going to start off by asking, what do you see as the biggest challenges and how do you address them? For instance, are there some topics, some that I just mentioned, that deserve more attention by the industry?
But I know for me, one of the biggest issues that I see is once you've been able to convince your GPs to give you the information at the granular level you need, and then you've integrated it into some sort of tool that allows you to view bespoke private markets information, whether it's a certain metric or a certain view. For me, the biggest challenge is taking that and then enterprising the data and trying to incorporate other types of illiquid assets or public assets to get that total fund view. So it's that last mile there to kind of get the most important information, which we need as an organization, which is the total fund return or the complete asset portfolio return. So that's often what I find is the most challenging, whether it's in my current job or in some of my prior lives. And some of the steps that you can take, although very difficult, to kind of overcome some of those issues is to kind of have some gates up front when you're digesting that information. And some of those gates might be, timeliness of that, or it might be as simple as having a common identifier across all the different systems that you have, whether it's at, a sub-ledger portfolio management tool, all the way up to your enterprise. So that, to me, it's not about the math. It's about trying to get the data and trying to structure it in a way that will give you good math outcomes or outcomes that are digestible for the organization. So I'll pause there.
Great, very good comments. Thank you, Brad.
Anyone else? Add on to what Brad said. You also have to be aware of the changes in the industries that are going on. So a lot of times things will happen very subtly and you won't notice something's happening. For example, when private equity funds started using lines of credit for their capital calls, it was a short-term solution for a logistical issue about getting calls into fund deals. Now they've turned into a year plus on the line of credit, so you now have a leveraged portfolio that, and some managers, some GPs assume that you want that because it juices the IRR. So you really need to be aware of subtle changes that are going on over time and be looking for them. And you do that really by talking to your managers, going to conferences, and I always think looking at the financial statements to see what's going on and question what's actually in the financial statements, because those can be very telling at times.
Yeah, thank you, Frank.
Okay, and I would echo the observations made by my fellow panelists here, and also, for us at TSG, we do a few different things. So a big part of our business is GIPS verification and consulting services to our clients, and we also teach classes on performance. So we see challenges with respect to alternatives through that lens, so to speak. One of the things we see, of course, is a lack of consistency in how firms are calculating and presenting performance for alternative assets, inconsistent use of best practices, lack of clear disclosures, proper disclosures, firms relying on spreadsheets for much of what they do rather than systems, and having data challenges, record challenges related to that. And I guess from a teaching standpoint, in dealing with accounting analysts and performance analysts, I think some people have kind of this fear of alternative asset classes. So they tend to see equities as easy and fixed income as a challenge, and alternatives, real estate, private equity, private debt, as being even more challenging. So I think there's an education challenge for people, but maybe we'll deal with some of that on today's webinar.
Indeed, we will. That's a great segue to our next topic, which is return and risk methodologies. And so everyone knows that money-weighted return, IRR, is the standard for most alt types. But do you report, for instance, performance multiples, DPI, TVPI, et cetera, for private equity, real estate, VC, or related asset classes? What about MOIC, MOIC versus IRR for private equity? What about XIRR versus MIRR? It's an alphabet soup of different measurement types. What do you guys think?
Maybe I'll kick off here a little bit and then hand off to my colleagues. Really, when we're talking about measuring performance for alternatives, it depends on a few things as far as what's the appropriate measure. It depends on the asset class we're talking about and the type of strategy, who's managing it, asset owner or a firm, and what the investment vehicle is that's involved. For an asset owner, we're typically talking about alternative assets being rolled up in the context of a total fund. So the use of a time-weighted return that's net of all fees and expenses is kind of the gold standard, best practice for the presentation of performance. And there, really, the relevant thing is being able to use proper valuation frequencies for the alternative assets that include cash flow adjusting. And I'll point out also that the use of an internal rate of return for the total fund has some relevance as well for an asset owner's total fund. When we talk about an asset manager, the calculation methodology depends on the vehicle we're talking about and the asset class. So for open-end portfolios or funds, time-weighted returns typically make sense. And for closed-end funds, where a manager has control of cash flows, a money-weighted return makes sense, and that would typically be a since inception internal rate of return or a modified DEETS. Now that said, keep in mind there's typically two reasons that we're using a money-weighted return. One is the control of cash flows, and the other is the difficulty to value the asset class on a frequent basis. So money-weighted returns, you only have to value at the start and end of the period. So for some of the asset classes like real estate and infrastructure, it may be relevant to present both time-weighted return and money-weighted return, depending on the audience and the type of investment vehicle. When we're dealing with assets where we're presenting the since inception internal rate of return, I think a key thing to keep in mind is that that internal rate of return is based on an ending value that's somewhat subjective in nature. And that's where the multiples, like the MOIC, if you prefer, or I would tend to say TVPI, which is essentially the same thing, the total value to paid in capital, the RVPI, residual value to paid in capital, DPI, paid in capital multiple. Those really are meant to give you some idea of where a fund is in its life and its profitability, and to be able to judge that return in context then. But that said, I'll hand over to my colleagues.
Yeah, I know when I think about all these metrics, I think the most important thing to remember is alts obviously has quite a few different types of metrics relative to publics, in my view, and probably a little bit more difficult to understand. I would say it all depends on the questions that you're trying to answer, or the audience that you're trying to project to. Like quite often you might be looking at deals, and maybe there are metrics that are more deal specific. And then as you kind of roll up to get a higher level governance, whether it's to an investment committee and then all the way up to a board, you need to filter out the metrics that are meaningful to them. right? So to me, it's not about which metric is the best that you need to do or the preferred metric per se. It's really understanding what are the questions that your audience is trying to understand, right? So for us, when we think about it, I probably counter your point where you say like everybody knows that money weighted return is how you should measure private assets. I'd probably argue from the other side that when we publicly communicate our private equity asset returns, or even to the board, it's not really the understanding of exactly how underlying deals are doing, which I would prefer to use an IRR methodology. What you're trying to answer to the public or trying to answer to the board is to help them understand the nuances and differences between different mandates, right? So it's not the private equity return per se that you might want to measure in IRR. You actually might want to say, this is my private equity return in a time-weighted sense, and then having it easily comparable so you can compare it to real estate. You can compare it to fixed income. You can compare it to equity. So from an asset owner perspective, and John was kind of alluding to this, you kind of could use either or depending on what you're trying to do. But from an asset owner perspective, if you look broadly across Canada and broadly across parts of the world, you will see a little bit more of time-weighted return being the primary metric when you're starting to measure strategies or asset classes. But that doesn't mean that the existence of IRR isn't relevant in an organization. It's just relevant in different areas. So I would just encourage everybody to remember, different metrics for different purposes. And time-weighted return, although not liked by most, I would call individuals that are private equity only people, is still heavily preferred by organizations that need to cut across asset classes.
Great.
Maybe I'll turn it over to you, Frank.
Yeah. Well, we'll move on to fees here, since that did come up and it's very important. And there's no surprise in these data from the Spaulding study, which shows that net of fees is the return standard. And so with alts, this means typically limited partner return net of management fees, carried interest, and expenses. And just a quick question, then we'll move on. What about fund of funds? Anyone use net of fees when there's two layers of management fees, carried interest, and expenses, or are there other challenges with alts in the net of fees topic?
I could kick this one off. We look at all the performance at the end of the day, so we're including all the fees are included. If a manager is charging too high of expenses, it'll come out in their net return, and they'll need to be able to explain that. But at the end of the day, we're looking at what is our return, what's the impact to us, to really be able to judge a manager and how they're doing.
Anyone else?
I would just add that it's important to consider the context of the reporting. So, if you're looking at the overall return from an investor perspective, then you want to look at that net of fees return and consider that the funds within a fund of funds are really, those fees are essentially trading expenses. So even if you do gross and net, you need to be net of those underlying fund fees and expenses. But if you're looking at investments within a structure, then comparability becomes important. So you might look at gross and then look at the fees separately.
Right. Yep. Very good point. Thank you, John. Let's move on to risk. And the Spaulding study reports these as the most used risk statistics when it comes to hedge funds, and here shown in descending order of usage. And then on the next slide, we show risk methodologies for private equity, again, in a descending order of usage. So while there's some overlap in risk metrics between publics and alts, at least insofar as the information here in the study, in general, there are many in the MPT realm that really aren't reasonable for many of the alt types. So considering the alts that you manage that are in your portfolios, which risk statistics are most important?
It's probably important to point out here, we can make a distinction between the hedge funds that are investing in liquid assets and the alternative assets. To some degree, you see some of the same suspects as terms of return calculations. So standard deviation based measures, I think on that first slide, to some degree dominate because people do what they're used to doing. Although we know, when there's derivatives and things like that involved in the strategy, you have non-normal returns, and standard deviation based measures are less reliable. And that's where things like drawdown based measures, Kalmar ratio, Sterling ratio, and things like that should be considered. When we get to the alternatives, again, I would say the use of value at risk, the drawdown based measures are common and more important than your standard deviation based measures.
Yeah, we definitely use different measurements for the hedge funds versus the private equity funds. I think one thing that has kind of complicated the picture recently is that a lot of our hedge funds have a lot of privates in them, and a lot of privates, especially mature ones, are having more publics in them because they're holding on to them for longer. So, we measure them, but also take in context to, what are we actually looking at? Are we looking at a pure private portfolio, or are we looking at a portfolio that's kind of mixed? And it's really a puzzle of sorts to kind of piece it together and, take it with the group, take it for what it is and just understand the full picture.
Yes. Brad, do you have any thoughts on this?
Yeah, I think there's a tendency in the industry that if you have lots of data, you can calculate a lot more things. And I think we all know that the data elements or data points on the public side are much more observable, much more frequent, which leads you to calculating a lot more risk numbers, right? And then using them for good purposes. On the private side, since there's less data points, you end up with fewer metrics. And some of the things that I often hear from people, which I think are wrong, is, oh, well, there must be less risk within a lot of these private markets because you don't have as many measures. So one of the things that we have to constantly remind ourselves as asset owners is we're here to invest on behalf of beneficiaries directly. So some of the things that people often forget about that are a little bit harder to calculate for math-oriented people is there's quite a bit of operational risk and reputational risk that needs to go into a holistic risk analysis for private markets. There is some of the, like under the iceberg kind of view is there's a lot of other risks that if you can't measure, you still have to find a way to triangulate around that. So asset owners actually have to go a little bit further than what you see in just the basic math or methodologies here. You got to go a little bit deeper and make sure you do holistic. And that's absolutely critical when you look at private markets, especially when you're investing direct, like many asset owners do. There is a significant reputational risk that beneficiaries can see if something were to happen. So I'd keep that in mind when you can compare and contrast against public risk-oriented metrics versus private.
Yes, yeah, very good points. And there are, as I think you're implying, qualitative as well as quantitative risk to be observing, and it's harder in some of the private asset types.
Yeah, I would just echo, you point out the importance of qualitative measures. When we're dealing with these alternative assets, ultimately when you measure risk, it depends on the valuations, and valuation of alternatives is difficult to do. It's subjective in nature, and there's a lot of research that shows upward market movements, say, of real estate prices tend to be understated, and the same thing with downward measures. So is volatility really being captured, and is risk really something that we can measure quantitatively? So using qualitative measures is very important, I think.
Right. Well, let's turn to one of the findings in the recent Dynamo LP research report. And this shows that a wide variety of approaches when asset allocators consider how they include privates in risk analysis. Two of these jumped out at me. 20% depending on manager supplied returns, and 34% not including them at all. What are you guys, what are your reactions to this?
I kicked that off. I mean, we we calculate our own returns for our managers, so that this way we know that we're comparing apples to apples. Because if you are using the returns from the managers, you're not sure, there could be different variances in what you're getting, especially in hedge funds that you may have some private allocation. The return that you get from a manager for a fund level may be different than your actual return is. Quite often will be substantially different. So you definitely need to, it's good information to have, but you got to kind of rely on your own in-house calculations to really determine what your returns are and measure them all up equally.
Brad, I know you had some thoughts on this.
Yeah, I know when I react to it, I kind of go like, as an asset owner, you wouldn't be doing justice for a governance perspective if you're absent and not even looking at it. Like, to me, that's quite surprising that occurs. Now, again, I'm also coming from a large asset owner that predominantly manages money in-house, so there are resources to be able to answer some of these challenging questions, whether it's with data, whether it's with modeling, etc. But to me, you have to find a way to incorporate these in. But at the same time, it can also reflect on organizations that maybe are a little smaller, that are in private assets, that rely upon others to do this for you. And they're not incorporating it because they're just not set up to do that sophisticated analysis, or maybe the tools historically have been really expensive, or they relied upon consultants. But at least in Canada and what we're broadly seeing around the world, that number's got to come down over time, and organizations are going to have to find a way, or else they're going to have governance issues, and they're going to have things that blow up that cause reputational risk. So I don't know, I'm surprised to see it, and I'd encourage everybody to think about how to fill that gap.
Yeah, it's interesting that over 1 out of 3, or slightly more than 1 out of 3, are doing nothing, which speaks to the challenges involved, and as well as the diversity in approaches, which I think, getting to what Frank was saying, ultimately it's, do you trust the data that you'd be getting to do these types of analyses? Can you rely on what you get from the underlying managers? Can you rely on the methodologies for modeling? Or do you have to find some way to do it yourself at a more broad, less specific level? So,
yeah. And so a lot of these issues we have found here at Dynamo revolve around data and data access. So let's talk about data. This is a key focus for us here at Dynamo, where our Dynamo Data Automation Service performs both document collection and financials extraction to improve the accuracy and compress the time frame for reporting performance and other measures on alts. So I'll be very interested to hear everyone's thoughts on this topic. And as we look at one of the stats from the Spaulding report, data lag is a big problem in reporting performance on alternatives. And most Spaulding study respondents here in the study chose 3 months as the lag time, which, anecdotally we hear as well here at Dynamo. And then from the Dynamo study, document collection and data extraction is the top investment process challenge. So clearly, timeliness and accuracy of data are major impediments to timely and accurate performance measurement. So, and I'll just throw out a couple of examples, but add your own. What challenges have you found with delays in reporting valuations after quarter end, extracting and inputting data, capturing all the components? I mean, the list goes on and on. What are some of the challenges you guys have found, and how do you deal with it? Right.
I can go first again, sure. Yeah, for us, it's kind of like, it's almost a trade-off, right? Is you need timely information and you want it to be accurate. I think a lot of organizations, and obviously finance math-oriented people, like precision. Like the number of times I've heard somebody say, I want to the third or fourth decimal for a return. From an asset owner perspective, like every single day we have to make decisions actively what we need to trade to make sure that our complete portfolio, meaning all the different private assets and public assets together, are directionally going where we want to go in any given day. So for us, although accuracy is critical, timeliness is even more critical, right? Because if we're trying to make decisions intra-quarter, we need the best available information at that point in time. So waiting 3 months is very, very difficult, right? So you may need to make proxy estimates of what private funds might look like 90 days when you get them, right? And you can make some inference based on maybe how publics have behaved versus privates through time. So to me, it's trying to get the best information available. And if that means doing something with partial information from a private equity manager, meaning maybe doing cash adjusted NAVs or making accounts for, let's call it, assets that have already IPO'd within a fund, you already know that stuff and you can observe it. You might be able to make decisions internally to kind of, at the margin, update the information to be a little bit more timely and maybe a little more accurate intra-quarter. So those are some of the things that we have to do because we're managing the fund actively together across all asset classes, basically on a daily basis. It doesn't mean we trade on a daily basis or make asset class decisions, but we definitely want to have the information if we want to, or if we decide we need to.
Right, great, yeah. Frank, I know you have a lot of experience in this realm.
Yeah, I mean, like Brad mentioned, you want information, you want it to be accurate. Those two things don't always match up real nicely. So, we have basically indexes benchmarks that we kind of use as a placeholder to kind of determine where we are until we have better information. And just, go on the best available information, but we also know to the extent of what that information is. So it's very clear when we're looking at our portfolio, we know what's a actual value from the manager versus a fund level estimate versus just a index that we've put in place as a placeholder to kind of gauge on where that should be. And having all that information and being very conscious about what you're looking at helps you make an informed decision. The other thing we do is we try and work with our managers as much as we can, which is kind of like climbing Mount Everest at times. You don't get very far, but from time to time we do see working with managers and for the LPs out there, the more that LPs that talk to managers say this is a real pain point for us, is there anything you could do? Sometimes you do make that incremental change where you go, you can get estimates a few days earlier, or the statements can come a few days earlier to really help you close your process out. So we've definitely found that to be beneficiary sometimes, to really work with the managers, let them know your concerns, and they will, usually work with you. Just take some time.
Great, yeah. I'm going to move on to benchmarks here, just in the interest of time. So benchmarks, of course, Frank, you just mentioned it, also present a challenge. For private equity, for instance, the standard approach is to use a PME, private market equivalent, which calculates the return that would have been achieved if the investor had invested in public market assets with the identical timing and magnitude as the private assets. There are a few methodologies: Long Nichols, Kaplan Shore, Cambridge Direct Alpha. Do you use any of these approaches? Do you use something else? Some specialized custom benchmarks for privates? How do you benchmark?
I mean, I can kick this off to start. I mean, really the PME methods, and they're all the same. I think the differences between them is beyond the scope of this webinar, but basically the idea is if you're presenting a money weighted return for a strategy, a portfolio, a fund, you really should be using a money weighted return benchmark. And the way to do that would be, or one way to do that, primary way to do that would be to take the cash flows of the portfolio or fund and notionally invest them in an index that you feel is appropriate, a public market index. That places some operational overhead on a firm to be able to calculate that, because you can't rely on published information because the cash flows are unique to the portfolio or fund. So you need to do this operationally, and then you need to have reporting that makes it clear what that measure is, because there may be questions on how did you arrive at this number. But that's the basic idea, besides other questions like how do you choose the appropriate index to use for such a measure, and some of the kind of related benchmarking challenges that we see with alternatives, the use of absolute return indexes and things like that. So.
Okay.
We spend a lot of time talking about benchmarks, especially for the alts, because there really isn't a great benchmark out there. I mean, you know, for public equities, you get S&P 500 or the Russell 2000, depending on what you're trying to measure. Basically, is what I've seen over the course of years is that you use a benchmark based off the asset class that you're in. So for hedge funds, you use a hedge fund index. I mean, knowing that you have a limited world there, the information isn't always timely, but it's really, you've made that decision to make that asset allocation to the hedge fund world. So you want to measure, the decision, you want to measure the decisions you're making, which hedge funds to measure against the world that you could invest in, which is really hedge fund. Same thing for private equities. We use our private equity benchmarks to really measure our ability to pick winners within that space. And like I said, it's not perfect, but it's the best that we view it as.
Right. Yeah. And as the final topic, and then we want to allow some time for questions, GIPs. So sometimes this is a fraught subject. To comply or not to comply, that is the question. So you two are both asset owners. You're not marketing to anyone. What's your feeling about the need of your organizations as an asset owner to be GIPS compliant?
I mean, from our perspective, we're it's not a concern for us. We calculate our own returns, and that's what we present. So this way, we know exactly what we're doing. So, it's nice to get it from the managers. So this way, we can compare apples to apples a little bit. But it's a challenge if not everybody's doing the same thing.
Yeah, I know for me, like when I speak personally here, it's like I'm a performance person. That's what I've done most of my career. Obviously, I have the CIPM, love GIPS, love the idea of an industry standard across the board. So from a personal perspective and then from a work micro perspective, let's call it within my group, of course, we love this type of stuff. We try and follow this best practice in every single thing we do and challenge internally and externally of what we see. Now I think broadly, not just our organization, but many asset owners, like previously, GIPS has really been focused on like how do you ensure fairness for marketing, right? For these asset managers that are going out there. So it's not that asset owners don't believe that these are important standards, but the carrot on the other side isn't quite as big yet, right? Because the carrot is, do our beneficiaries believe that what we're doing is accurate? And I believe they do, and I think this would enhance our reputation. But I think most asset owners now are kind of just starting to think about it. And I know CFA Institute's come out with some let's call it more targeted guidance for asset owners. So I think a lot of people are talking about it now, and it's just making the organizational priority of, is this a focus of what we want to do against all the other competing priorities that we have in the organization relative to the carrot or the reward that you get at the end of the day. But what I will say from an asset owner perspective, there's lots of talk about it now. 5 years ago, nobody was talking about it. So usually with talk, eventually comes some action, and then comes a few firms that will accept. And then I would expect through time that you will see this more as a general practice for asset owners across the world, or at least North America.
Thanks, Brad.
Right.
John, 30 seconds. You got any thoughts on this? Now we're going to move to
30 seconds. Wow. Well, so the GIPS standards have changed over the last few years, as Brad mentioned, to make compliance more feasible for asset owners, and we're seeing a number of public pensions follow CalPERS and others claiming GIPS compliance, and our recent survey shows that trend continuing. We're also seeing sovereign wealth funds to some degree start to adopt the GIPS standards. So in the alternative space for asset managers, however, adoption is slow. I mean, we do see real estate managers to some degree claiming compliance with GIPS, infrastructure, and less so for private equity, private debt managers. But But that said, for both the asset owners beyond the groups that we talked about and the asset managers, I think the GIPS standards do provide a good framework for what is best practice. And we do see some of these groups, while not claiming compliance with GIPS, doing performance verifications of other types. So the importance of the standard is there, even if these entities aren't claiming compliance. So.
Yep, very good.
37 seconds.
A long time. That's okay. That's okay. So we do want to allow time for questions. This has been great. You guys have been awesome. And I'm going to turn it back to Donna for some live Q&A.
Excellent. Thanks, Mike, and thanks to all of our roundtable panelists. I'm going to dive right in here. How do you deal with the lagged nature of private assets in performance calculations?
I can start with that. I mean, we know that our reporting we do our reporting to our committee on a lag basis as well. They know that, the valuations come in late and take some time to come in. There's no way around that. I mean, you can't report something that you don't have. So you just need to get it when you get it and try and process it as quickly as possible and get that information out there. And I don't see any other way around that.
Yeah, on our side, we do let them lag from an enterprise view. So all of our reporting is lagged for external funds. For internal assets, we try and get them as marked to quarter end as possible. So generally a little bit more fluid. That said, quite often in, let's call it portfolio management tools, you will have some analysis that is done on a, let's call it unlagged basis, so that you can get as close to what the manager is doing as possible. And I think that provides useful information. So we do a bit of both, but enterprise perspective, we accept the lag because we care more about timely information, meaning disclosure of that for leaders and the public versus having the most accurate unlagged one 90 plus days later.
Excellent. Thank you, Frank and Brad. All right, next question. Do you think that the SEC's new rules on private assets will lead to more alternative managers moving to GIPS compliance?
That's interesting. I'm not sure. I'd say probably not. Meaning I don't think that it'll affect adoption of GIPS. But I think it's to be seen. Yeah.
Excellent. Any other thoughts? Good. All right, let's keep moving. All right, the next question. What time periods make most sense when you're evaluating performance of private assets?
I know for us, you have to have the trade-off of useful information in the short run and then pure evaluation. So you can't measure private markets at the end, meaning after a full cycle of funds, maybe 7 to 10 years, but you can't focus on 1 year. So in our organization and in many organizations, they somewhere go between 4 and 5 as a good offset between too long and too short. So on our side, we generally look at 5 years as an indication holistically how a particular asset class is performing, and that's consistent across public and private.
I mean, for us, for privates, I mean, we're, when usually a manager will have multiple series vintages of funds, so we'll look at those and see where they're performing within their vintage years, and that kind of really helps us a lot to make a decision of whether or not this manager is performing the way it should be. But usually once you're in, and you can't really get out unless you do secondary sales. So it's really about looking at what they've done in comparison to their next fund offering that you're thinking about going into or not going into.
Right, I would say the same thing.
Oh, go ahead, John.
I was just going to echo the same thing. Yeah, you really should look at past funds with a similar life, so a similar time from vintage to termination, and then consider the market conditions that each fund faced make the choice accordingly.
Excellent. Well, thank you to all of our panels. We are at time at this point. We do have many questions though coming in. So you know what we'll do? We're going to respond to each of you individually and get you those answers that you're looking for. But thank you to such an engaged audience today too. We really appreciate the interest and the level and detail of questions that are coming over. As you exit today's session, there is a short survey that will pop up. And we'd really appreciate any and all feedback you'd be willing to provide. Don't forget to take a look at the handouts area. Today's session was recorded. You will receive the on-demand link within the next 24 hours, and you'll be able to replay it and also get access to those materials again, too, in the handouts area. Thanks again for everyone who joined us, and especially to Mike Slummer, our terrific moderator, and all of our roundtable panelists, Brad, Frank, and John. I hope everybody has a great day, and we hope to see you again soon.
Thank you.
Thank you.